If your chart looks anything like this, a chaotic cascade of red where every sudden drop triggers an emotional reaction, you are likely trading without a mechanical structure, and reacting to raw price action inevitably leads to unpredictable losses. To address this, we use a system built on change of character signals and Fibonacci retracement zones. It provides a sequence of objective markers to identify where institutional traders reload their positions, replacing subjective guesses with fixed price action rules. By adopting these precise mechanical rules, you stop guessing. Instead, you learn how to identify a market's true directional shift early, long before the rest of the retail crowd even realizes what is happening. We start with the foundational language of the market: structure. This diagram displays the 4 core building blocks every trader must know. On the left, price forms stair steps upward, creating higher highs and higher lows. As this upward section illuminates green, it marks an active uptrend. In this environment, your rigid rule is to look exclusively for buy setups. Buyers are fully in control, and taking short positions here is mathematically unfavorable. The exact opposite applies on the other side. When the market generates lower highs and lower lows, sellers are driving the price down. You must restrict yourself to looking strictly for sell setups. Skipping this evaluation step is a fatal error. If you misread this basic market architecture, the rest of the strategy simply does not apply. Correctly identifying the active trend is your primary protective measure. Watch this chart. In a downtrend, price suddenly spikes upward, slicing through the last lower high. This break is a change of character, CHoCH. Treat it as a warning. It signals shifting order flow, never an immediate entry trigger. Entering a trade the moment a change of character fires is a high-risk move. Without the confirmation steps that follow, price can easily reverse, trapping traders in a false breakout before the trend has actually shifted. To protect yourself from those fakeouts, you have to wait for the mandatory confirmation step, the break of structure, or BOS. This is the event that proves the institutional shift is real and a new trend is actually underway. Let's follow that same chart. After the initial CHoCH warning, price pulls back slightly, then surges upward again to form a distinct new peak. That new peak is definitively higher than the initial spike. That is your break of structure. By demanding that break of structure, you force yourself to wait until the market completely reveals its intent. The new uptrend is now mathematically confirmed, bringing your risk level down significantly. Now that the trend has reversed, we need an entry point. Smart money rarely chases breakouts. They wait for pullbacks. To find out exactly where they cluster their limit orders, we use the Fibonacci retracement tool. As you see on this diagram, application requires strict precision. You anchor the tool exactly at the lowest valley, the swing low just before the CHoCH occurred, and stretch it all the way up to the newly formed highest peak created by the break of structure. This reveals your primary target, the golden pocket. It is a highly concentrated zone resting precisely between the 0.618 and 0.786 retracement levels. You do not buy the moment price touches the line. You wait for price to fully penetrate the golden pocket, pause, and print a strong rejection candle. That rejection is your final execution trigger. Waiting for this specific zone requires patience, but executing your trades deep inside the golden pocket mathematically maximizes your potential reward while compressing your risk window to the smallest possible margin. Let's lock in the complete mechanical checklist. For a buy setup, identify a clear downtrend. Spot the bullish change of character. Wait for the break of structure. Map your Fibonacci grid and enter only upon a strong rejection inside the golden pocket. The sell sequence is an exact mirror image. Confirm an active uptrend. Log the bearish change of character. Wait for downward break of structure. Anchor your Fibonacci from the high down to the new low, and short the pullback into the zone. Every single trade must follow these exact 6 steps. Treating this sequence as an unbreakable law is the dividing line between having a true mechanical edge in the market and relying on emotional guessing. This system only works if the environment is right. Look at this comparison. On the left is the clean, stair-stepping structure we require. On the right is a tight, choppy sideways range. Attempting to deploy this strategy inside a consolidating market is a fatal error. Inside those ranges, institutional players execute a manipulation cycle called the jab. They intentionally engineer fake change of character signals, abrupt spikes in one direction. specifically to trick retail traders into buying the breakout, right before reversing the price to sweep their stop losses. You defeat the jab by simply refusing to play. Having the strict discipline to sit on your hands and do nothing during a range-bound market is the ultimate protective shield for your capital. Even with the highest probability setups, safety checks are non-negotiable. Step 1 is a hard cap on your exposure. You must never risk more than 1 to 2% of your total account capital on any single trade. Your stop loss is rigid. The narrow red risk block must anchor safely beyond the 1.000 Fibonacci level. Next, evaluate the payoff. The expanding green reward block must mathematically equal at least twice your risk. If the return is below 1 to 2, abandon the trade. Following this protocol ensures every trade is backed by a confirmed structural shift, an institutional entry zone, and a favorable mathematical ratio. It replaces the uncertainty of random price movements with a repeatable execution engine.